Good morning, everybody. Happy Aloha Friday, as we like to call it around here at our firm, Mocha Investors, LLC, and also its wholly owned subsidiary, Virtue of Selfish Investing, LLC. We'd like to welcome you to today's commemorative, I'd say, webinar as part of our boot camp series. We're doing a three-part boot camp series in conjunction with the launch of our new book, In the Trading Cockpit with the O'Neill Disciples. And this is intended as about a 30 to 40-minute instructional presentation on pocket pivots, session 1 of Disciple Bootcamp, as we call it. For those of you who are unfamiliar with us, we are known as O'Neill Disciples because we appeared in year 2000 in a book that was published by TradingMarkets.com called, it was titled The Best Conversations with Top Traders. Dr. Chris Katcher and myself, Gil Morales, we were in the first chapter, and the title of that chapter was The Disciples, and that's where we got that name, and we use it sort of as an inside joke in our book titles as well as these webinars, as you can see on the title here. But anyways, what we're going to talk about today are pocket pivots. So we want to focus on this, and the intent here is that for those of you who are unfamiliar with pocket pivots or who are less familiar than you'd like to be and would like either a primer or a refresher type course on pocket pivot buy points, we're going to do that now and include some more recent examples. We might also discuss some more recent pocket pivots that we've seen in the last few days, but we really do not have time to get into a general discussion about the market. And also, because we do have a intraday webinar service for the members who subscribe to that on virtueofselfishinvesting.com, our advisory website, we also don't think it would be fair to them since they do pay for that service. So we're not going to take a bunch of questions on individual stocks and whatnot outside of the pocket pivot topic of today's Disciple Bootcamp Session 1. So now that we've got everybody coming on, I can see we've got a full house here today, so I'd like to thank everybody for showing up on a Friday morning. Without further ado, I'd like to just move through this very quickly and just point out that on the charts you'll see various moving averages. The magenta line is always a 10-day moving average, simple, and the green one is a 20-day simple moving average. The blue is a 50-day simple moving average. There is a black one you'll see in some charts. That's a 65-day exponential moving average, and the red one you'll see is a 200-day simple moving average. We don't use all of them. Primarily we focus on the 10-day, the 50-day, and the 200-day, but there are some instances where I like to use the green or black, the 20-day or 65-day, when trading stocks like the SLV and commodity-related stuff. So, and also on the short side it comes in handy. But it shows up on our charts. We didn't take them off all the charts, so just in case you do see them, we didn't want to confuse you, and this way you'll know exactly what those mean. But basically, let's start out with an answer to the question, what is a pocket pivot? It's a cute name. I've even noticed that the whole term pivot point, which was originated by O'Neill, actually you could say Jesse Livermore, who used to use pivotal point, but William O'Neill took that and made it pivot point, and we've taken a little further by calling things pocket pivot points, and I noticed that shows up on the major financial media these days, so it is kind of growing in popularity as a term, and I saw this morning somebody discussing Morgan Stanley as being at a pivot point. I haven't looked at the chart there, but I'm not really sure what they mean by that, but it's interesting that they use that terminology. But in any case, a pocket pivot is basically an early buy point within a potential leading stock's consolidation or basing pattern. So you'll see them within a base, sometimes in the lower part of the base, or as the stock is coming up the right side of a new potential base or a potentially new base. And it's a very subtle buy signal that is not necessarily a breakout. So when utilized as a buy point within a consolidation or a base, it provides an early mover advantage to the investor. Another thing is often a sign of initial strength in a, say, if you're in a correction or a bear market, say an intermediate correction or a short-term correction, in a bearish sort of phase, you'll see some of the better stocks issue pocket pivots in their bases as they hold up, and that's usually a sign of initial strength or cluing you in that this may be a stock that will turn when the market turns and do so much more quickly. Now, not only are pocket pivots buy points within a base, but they also function, and this is where I really find them even more useful, they function as continuation buy points for a leading stock that's already in an uptrend. So in other words, once you have the breakout in a stock and it moves to new highs and it breaks out and runs up 10, 15%, you're left with the problem of where can you add at a logical area that is relatively low risk. We don't think that the idea of simply adding up 2%, add more to your position, up another 2%, add more to your position, and do it that way. We don't find that to be so efficient because in this environment, a lot of stocks will whip right back into their buy point, their original breakout buy point. And so what happens is you end up with a bigger position than you might want to get as it moves up initially, and then it yanks back on you, and you're a little bit top heavy. So in other words, your average cost on your position is a little heavy. So what we wanted to find was a coherent way to add to our positions without getting ourselves too extended. So essentially, this offers both a way to get on board strong leaders later on in their uptrends, as well as being essentially or extremely reliable and powerful tool for adding to positions purchased earlier when a stock was still within or just emerging from its original consolidation or basing formation. So you can also use a continuation pocket as a way to get on board a leader that's already moving and has already come up and out of its base. And of course, you have your parameters for your selling guide when you do take such a position, and we'll get into that as we progress through the presentation. So basically, pocket pivots are unique buy points. They rely solely on their own criteria. They don't rely on having to have a certain amount of percentage volume like a standard base breakout. And you can see in this chart of Chipotle Mexican Grill from 2010, you can see the two pocket pivots on the left side that are labeled PP, and you see the third one that occurs up along the 10-day moving average. But the first two are within the base, and so these are your early mover advantage buy points. And then you have the standard base breakout. Now, sometimes a pocket pivot can coincide with a base breakout and usually adds additional weight to the breakout, but sometimes you can have a base breakout that is a pocket pivot but does not trade enough volume to be a standard issue O'Neill style base breakout, but you can still buy those. So it is a unique buy point in the sense that it does not rely on any other criterion other than its own. The basic premise of the pocket pivot is that institutional buying creates new high base breakouts, but we also know that institutional buying occurs within consolidations and during uptrends. Given my and Dr. Ketcher's experience working on the institutional side of O'Neill back in the late 90s and the early 2000s, I can tell you that institutions don't necessarily buy breakouts. They create breakouts, but they don't screen every morning and look for breakouts, and they'll see a stock breaking, oh, let's go jump in and buy it. They're usually creating the breakout. So they either create breakouts or they're buying within consolidations and off the lows of bases. Somebody has to create the lows of a base. That's generally an institution, because the rest of us are looking around for a breakout to buy into once the stock is up and out of its base. So they're also buying during uptrends. So our feeling is that this buying within consolidations and uptrends should theoretically have its particular identifying price and volume signature. So the pocket pivot describes that signature and provides a clear, viable pivot point, or a pocket pivot buy point, as we like to call it. Pocket pivots also provide a tool for buying leading stocks as they progress higher within their uptrends when they're already extended from a prior base or price consolidation. So I think you can get a sense of the advantages that pocket pivots offer you, but they're not a panacea. There are times when they won't work, and sometimes when you see a lot of pocket pivots and they're not really coming through or following through, they're breaking down. That can tell you you're sort of in an uneven market. We've seen some of that over the last month or two, but it seems like the situation is improving more recently. Somebody asked a good question, what is a base? A base is essentially a sideways movement in a stock. So let's go back to here, and if you're looking here, this is a sideways consolidation, so that's a base, and you're breaking out here through the top of the base. So that's really what a base is, essentially a sideways consolidation. If you're familiar with O'Neill's work, then you know what a base is. It's is basically just a consolidation, a sideways consolidation that the stock is in, and it breaks out from this. So really, pocket pivots are just a way to identify institutional investors' footprints within a base or an uptrend. So when you're looking for those clues as to where the institutions are coming in and buying, we think pocket pivots are one way to see their activity, and it's very subtle. And for those of you who aren't familiar with what an institutional investor looks like, you can at least get an idea of the size of their foot, which is pretty big, and they do run around barefoot. My theory is that many of them may be aging hippies, but I'm not sure. Essentially, we can break it down into the 10 commandments of pocket pivots. So we'll go through these three at a time, rather than hitting them all at once to make it easy. And essentially, the three first leading, I think these are probably the most important characteristics, the first three here, three essential characteristics, is that they should emerge within or out of constructive basing patterns, and they should be occurring in strong stocks, fundamentally strong stocks, basically the leadership of the day, and the stock showing strong earnings, strong return on equity, or which may have a compelling thematic basis for consideration. So keep that one in mind, because we'll talk about that in just a second with some of the examples. Now, the critical aspect of any pocket pivot is number 3, and that is that the day's volume should be larger than the highest down volume day over the prior 10 trading days. So that basically means you're looking for the volume on any particular day when a pocket pivot occurs to be higher than the volume on any days that were down days over the prior 10 days. You can have an up day, and that would not count against you. So basically, you can see here, here's a very obvious one. This big spike, this big blue spike on this pocket pivot, that's obviously higher than any down volume day over the prior 10 days. You can see this one spike right here. This red bar here is a down volume day, and you can see this is clearly higher than that. Now, sometimes pocket pivots can be much more subtle, and you can see in this example here, the magenta line is your 10-day moving average, and you can see the stock coming up through the magenta line, and you see this volume bar here. It's actually higher than this red bar here and any others over the prior 10 trading days. That qualifies as a pocket pivot. So that's actually a buy point, and it's occurring before the breakout and on volume that really is not above average. This blue line that you see going across the top of the volume bars is the 50-day moving average of volume, and you can see that you're not even getting up to average volume on that day, but it is a buy point. And then it's followed 3 days later by a base breakout through the top of this consolidation or base. You can also see here Chipotle Mexican Grill at the time had pretty strong earnings, so very strong situation. More recently, we've seen pocket pivots occurring in Valiant Pharmaceuticals, for example, and here you can see the volume bar is higher than any downside volume bar. This one is the highest one here 2 days prior, but it's higher than that and higher than any of those downside volume bars in the pattern over the prior 10 days. You can see it's coming up off of the 10-day moving average, the magenta moving average, as well as the blue 50-day. So in this case, you have a stock that's sort of rounding out this consolidation. Notice how it gets nice and tight. It's moving sideways, pretty tight sideways here. Then boom, there you go, and that's your buy point. And you can see quite easily that this is well below what would be a new high base breakout, which occurs up in here on this gap up move later on, and much higher in the pattern. So here you've got a nice early mover advantage on a stock that is a leading stock currently in this market. Here's another example, Rackspace Holdings back in November. It's coming up off of this sort of double bottom consolidation. So this whole area here is a consolidation. It goes tight here right along the 50-day moving average, and then comes up and off, pulls back, but holds above the 50-day moving average, and then it breaks out. So if you're able to get in here, it's a rationale for buying a stock and taking an initial position so that you have an early mover advantage for the later breakout. Now you can also see here, this is occurring after it's already broken out of the base here through the 69 level, roughly, and it's already up and out of there. But here's another point where you see a pocket pivot occurring off the 10-day moving average while the stock's in an uptrend, and that's a secondary buy point. So you actually come in and add to your position right there. Here we have another one in Ocwen Financial, which just occurred a couple of weeks ago. The stock is hanging out up around a 38, 39 level currently, and you can see the pocket pivot. You have this big volume spike. Again, it's higher than any down volume bar, these red bars, higher than any of those over the prior 10 days. And that's the pocket pivot because now you're up here. A base breakout would be through the 39.40 area. But if you're in here, you're already in early. Commvault Systems has been a little bit of a volatile stock, but it issued a pocket pivot off of the 10-day moving average back in late November, and you can see how, again, the volume bar is higher than any down volume bars over the prior 10 days. And this is coming up from a position where the prior day it closed right at about the 10-day moving average, and it gaps up a little bit and moves higher, and it's actually held the low of that day throughout this whole movement over the past several weeks. When Michael Kors came public last year, actually in December of 2011, and last year during January, the early part of the year, it began a nice price move. That was actually a pretty large price move. It actually began with a series of pocket pivots, and here's one coming out of a little flag formation. And this is essentially about a 3-week flag, and there's, again, you see the volume bar higher than any downside volume bars over the prior 10 days. Then as it moves higher, you get another one off of the 10 days. So this is a continuation pocket pivot, and then 6 days later you have another one. This volume bar, it's hard to see here, but it is higher than any down volume bar over the prior 10 days. And so you actually could have been buying here, here, and here, and you would have been in position for this nice move to the upside. InvenSense was another stock last year that started out with a pocket pivot, and I think this illustrates, particularly with these more volatile, thinner names, why you want to have an early mover advantage on some of these, because if you get in here, you're able to ride through this move and maybe sit through this pullback, because then it issues another pocket pivot right along the 10-day moving average as it jerks up, and it's a little bit V-shaped, but it is support off the 10-day. And it continues to move higher, and then it gets very choppy here. And it might have been difficult to hold through all of this, even if you were buying into these buy points. But if you're able to get in here early, then I think it's much easier to handle something like this. And when it did break down, because InvenSense did break down later on, and it did not follow through with its initial strength, you were in a better position to avoid heavy losses. Now, we talk about how you want to see stocks that are fundamentally strong as candidates for pocket pivot buy points, or stocks that you're going to buy into when they issue pocket pivots. But there are exceptions to this, in that if there is a compelling fundamental theme, so let's take the example last year, the year before rather, in 2010, of the whole theme of rare earth metals. And that was a big theme, and it drove several stocks higher. The leader among these, however, was Molycorp, and the biggest part of the move actually occurred off of the lows of this consolidation. So you can see it's going sideways, pulling back, and you get one pocket pivot here, and then it pulls back again, holds the low this day, and then breaks out through the 50-day on a pocket pivot move again. And notice it's not breaking out to new highs. That doesn't occur until you're up here. And at that point, you're coming almost straight up off the lows in a straight uptrend without any real pause, and that might be difficult to buy, but you could be buying these pocket pivots right here, and you would be in early to catch this move higher. Now, one thing to keep in mind is that when you see pocket pivots, you want them to be occurring at a point where the stock has been going sideways. So where you see it's coming down through the 50-day moving average, and then it has this pocket pivot here. It doesn't have any upside thrust. It sort of drifts back down, mainly because it's still working off of this little downtrend. So it's not enough to reverse the stock, but it's showing there's some strength along here. And you don't really want to buy them when they're in this sort of position where they're in a downtrend coming down, and then they have a pocket pivot. You'd rather buy one that's occurring after the stock's been quieting down, and you can see the volume here picks up, get a couple of above average or average volume days as it comes down, and then you get the pocket pivot, and as it pulls back here, notice how the volume tends to dry up in here, and then boom, you get a second one that's occurring off of a better position where the stock has been moving sideways. And then Molycorp had another one a few months later, coming off the lows of its base, another big pocket pivot coming up through the 50-day moving average and the 10-day moving average, and that led to another move in the stock. So you actually could have been owning the stock from way back here when it had its first pocket pivot at around the 30 level, which would be down here. You had this move, then this base. You could be adding again and capitalizing on the next leg up. Here's Decker's, where you see a couple of pocket pivots, one within the base, and one here just as it's breaking out that actually coincides with well, not really. This is the base breakout here on this day, this gap up day. So it's actually showing pocket pivots before it's emerging to new highs. Baidu as well. I don't know if anybody remembers this from 2010 when the VP or Vice President of Sales came out and intimated something about sales not being what they expected, and the stock broke down through the 50-day, but then it came right back up and issued a couple of pocket pivots along the 50-day moving average, and then from there it gapped up and took off. So you actually could have been buying the stock. Let's say if you had owned it in here and you got shaken out, it moves back up if you were smart enough to, I think, and open-minded to take the evidence in real time for what it was worth. So what if you got shaken out here? You could easily enter back into the stock here and then be in position to benefit from this big gap up move. You also see you had a pocket pivot in the iShares Silver Trust back in 2010 after it started a huge move to the upside. Rule number 4, pocket pivots sometimes coincide with base breakouts or with gap ups. This can be thought of as added upside power should this occur, and we already talked about that, and you've seen a couple examples of that. Now, here you see Lululemon, that's a base breakout, which is also a pocket pivot. You see Riverbed Technologies breaking out of this base, and that's also a big pocket pivot here, but you can see that there was a smaller one the day before. And the stock breaks out, pulls back, and holds. Remember, we were in a little bit of a choppy environment during July and August of 2010. In fact, the market was in a correction, if you all recall that. And yet, Riverbed was showing initial strength. This pullback was actually normal, and it held basically above the breakout level. Then it continued higher. And you actually, if you're paying attention here, you can pick out a couple of other pocket pivots right here and right here that could have also been bought into. And you could consider these to be sort of a new sort of short base breakout because it comes out of this little mini cup and handle formation. Rule 5 and 6 have to do with what we're talking about as continuation pocket pivots that you can buy in a stock that's already up and out of its base. So let's just show one. Fleetcor Technologies is already broken out here on a gap up and is moving along the 10-day moving average, and then here's an add point right here. Even though it closes below the mid-range of the intraday trading range, mid-bar say, that's still okay as long as it holds above the 10-day moving average. Sometimes these things can stall a little bit, but as long as they're able to get back up and keep going, then they're still in play. And so this is a good example of one that occurs a pretty heavy volume. It looks like churning, but as long as it's able to hold above the 10-day moving average and close positive on the day, it still is viable. So not always the most optimal pocket pivot, but these can work. And as Fleetcor Technologies has shown, going into the end of 2012 and early 2013, this can actually work, and it does. Coffee Holding. Notice here's the, somebody may remember this, Java. You see the breakout here. That's a pocket pivot, and then it starts to move rapidly. Then you can actually buy this pocket pivot. Here you have a upside bar that's higher than any downside volume over the prior 10 days, including this one right here. And the stock jets to the upside from there. It gets a little climactic, and you want to sell into that, and then it comes back in. And I think that was pretty much the move there. But even here, a pocket pivot would have gotten you in here, and a pocket pivot would have gotten you in here for a nice 6-day blast to the upside. Now, there are pocket pivots, as we showed with that Molycorp formation, that we don't consider optimal, depending on how they form within their chart patterns. You definitely do not want to buy pocket pivots in a stock where the overall chart formation is in a multi-month downtrend, 5 months or longer. It's better to wait for the rounding part of the base to form before buying. In other words, the stock should bottom and start to round out a low and start coming up the right side or coming up off the lows in a constructive manner. You also don't want to buy pocket pivots when they occur under what we would consider a critical moving average, such as the 50-day moving average or the 200-day moving average. If it's way below its 50-day moving average and getting some support around the 200-day moving average, then they can be bought provided the base is constructive, and we'll look at a couple examples here. Here's Baidu coming down. It's in a downtrend, and you have a pocket pivot here. You don't want to buy that. You can see it's below all the moving averages. Everything is in a downtrend. The moving averages are trending lower. So really not the type of situation you want to be buying into, and this would not qualify as a pocket pivot. Here's Research in Motion. getting some pocket pivot action here while it's in a downtrend with several gap downs. Interestingly enough, I remember Research in Motion when it was around 68 bucks. I think it was selling at 7 times estimates, and everybody was saying that the stock was cheap. And I guess now at 11 bucks or so, whatever it's at these days, 12, 13 maybe, it must be even cheaper. But for those of you who think Apple is cheap, just rest assured that stocks can get a lot cheaper. And RIM certainly did that, even though you had a pocket pivot here. Again, you're in a downtrend. You're below both of the major moving averages. You might even notice you have the 50-day crossing over the 200-day. Just nothing is set up properly here, and it's not a constructive pattern to be buying a pocket pivot from. You also don't want to buy pocket pivots if the stock formed a V where it sells off hard down through the 10-day or 50-day moving average and then shoots straight back up in a V formation. These are failure-prone formations, and we'll give you an example. Here's Lulu. See how you have a V sort of movement here, and you get a pocket pivot here coming up through the 50-day moving average, and that one pulls back and fails. So you don't want to buy that sort of thing. Remember, we're talking about you want to see nice, tight, sideways movement here as the stock settles down and quiets down and prepares to launch higher. Amazon, here's a breakdown, okay, and then you see the pocket pivot occurring right here. That's a V-shaped sort of movement here, and that quickly fails. So you really don't want to be buying that sort of a movement. And of course, you don't want to be buying pocket pivots that occur after wedging patterns. This always brings up the question, what is a wedging pattern? And I see we have a lot of questions, and we're going to get to those in just a second as we wrap up here. But a wedging pattern is essentially when a stock is in a rally phase where you're not seeing any really big buying volume, and it's relatively light. So it's really just kind of drifting and wedging higher. So it does that, and then you see a pocket pivot. Most of the time you'll see these fail, and you can see that happening here on Carpenter Technology in 2008. It's drifting higher. There's no real big volume in here, so it's wedging higher, and then you get the pocket pivot, and boom, it rolls over. Lululemon Athletica. See, here's a slight wedge. You can see the volume is declining here as it's sort of drifting higher, and then it breaks out on a big pocket pivot, but then pulls right back in. So you probably would be better off buying into this one, which is correct, rather than buying into this one. But you see a lot of times those sorts of moves need to pull back, and they'll come in and correct the wedge. That's what this helps to do, and set up the next movement higher. Now, bottom fishing pocket pivots occur sometimes, but they're very rare, and they only occur in big leading stocks. That's really the only type of stock we want to buy on a bottom fishing pocket pivot. But you can see that Priceline.com in 2010 broke down with the market, and you can see how it rounds out the bottom and starts to create a real low here rather than trying to pocket pivot, say, after this downtrend, because we would not want to be buying this on a pocket pivot while it's still in a downtrend. You can see here you have a move on volume that's higher than any down volume day over the prior 10 days. But this is really a little bit premature, and it breaks down again. But see, now with this movement, you're sort of shaking out the sellers. You're seeing volume dry up along the lows, and then you start to see these pocket pivots coming up through the 50-day moving average on this first one here, and the second one comes up to the 200-day moving average. So those can be bought using the moving average as your selling guide. So if it gets up above the 50-day initially, you buy it, and you use that moving average as your selling guide, and then it comes up below the 200-day, above the 200-day 2 days later, and you use the 200-day moving average as your selling guide there. Here's Google doing almost the same thing, but again, notice how you can see the base is rounding out and the downtrend is losing its downside thrust, so to speak, and you're starting to mellow out and round out the lows of this consolidation. You can also notice that you'll see volume drying up. You see these selling spikes. They keep getting smaller and smaller along the lows, and then you really dry up in here before you see this first pocket pivot coming up and off the 50-day moving average, and then another one coming up through, and on a closing basis, you'll notice the stock holds up above the 200-day moving average the whole way, and that works pretty well after the stock gaps up again on earnings. So a way to buy some of these stocks off the lows, if they're big, institutionally favored big stocks, in the market, like a Google or a Priceline or an Intuitive Surgical. Same situation here. Here's a rounding out of the base. You can see it gets nice and tight in here, moves tight sideways, and then boom, you come up through the 50-day moving average, and you're up and out of there. LinkedIn also had some bottom fishing pocket pivots in the earlier part of 2012, and those have actually held up since then, but you can see them coming up through the 10-day moving average in this case after the stock has been able to rally, and it's getting a little tighter. Notice how you're very loose in here, and then it starts to, the price bars, the intraday price bars here start to tighten up, and the range is lighter, and you can see that it gets tight in here, and you have a couple of pocket pivots, and then it moves higher from there. So in summary, pocket pivots function as early buy points within a base or as continuation buy points once a stock is extended from a prior base breakout. And I like to use pocket pivots as a continuation buy point because I think they're very useful that way to either add to positions or even jump on board a stock that's taking off and looks like it might be too high to buy. Pocket pivots are often strong clues during market corrections when they occur within the base or consolidation of a potential leader just before a market bottom and new rally phase. But remember, pocket pivots are not a panacea, but they do offer an edge in today's markets. And Dr. K or Chris Ketcher, Dr. K, you're out there. I know. I hear you typing out there. And just to talk about this subject here, they offer an edge in today's markets, and I think you could probably speak quickly about what was the genesis of the pocket pivot. In other words, we know that necessity is the mother of invention, and how did that work with the pocket pivot?
Well, 2004 to 2005 were flat, begrudgingly bullish markets. They were nothing like we saw in the 80s or the 90s. So the markets in 2004 and 2005 would take 4 steps forward, then 3 steps backwards, and that resulted in base breakouts not working. So I went back to the drawing board and thought, well, if these old techniques aren't working because the market's changed, what will work? And what I discovered, really observed, because you don't really discover things, you observe them. I observed a pattern, a statistically favorable pattern that was profitable. That is in the form of pocket pivots, and also there's other buying techniques as well, like Bible gap ups, which we'll talk about in the next seminar. But nevertheless, in mid-2005, I had done rigorous research into many market cycles, going back a number of decades, on this observation I made, and I found, to my surprise, that it would have greatly enhanced my trading in the 1990s. And it was the panacea for the troubled, begrudging markets of 2004 to 2005. And it allowed me to finish the last quarter of 2005 up strongly, as well as the last quarter of 2006, where I more than doubled my account, simply by the use of these pocket pivots. And incidentally, the last quarter of 2006 was the last real strong uptrend that was leadership-based. So we haven't really seen a proper uptrend since then, and nevertheless we have QE motivating the markets higher. So what we've got is pocket pivots that will help these types of challenging times we find ourselves in, where base breakouts are usually nowadays, the last to know. When you're buying a base breakout, the odds are still quite against you that it's going to work. So you're better off buying in the base before the breakout, so your average cost is lower. So if the trade doesn't work, then maybe you're going to break even instead of losing money, and maybe you'll be even up a few percent. So you won't have death by 1,000 cuts.
We've got a few questions here that I think we'll try and answer if we think they're unique. But most of the questions that people are asking, we have an FAQ section on our website, which you can get to at selfishinvesting.com down here at the bottom. These are actually the 2 covers of our books, and yes, we see the typo here, strategies, but that has been how do you pronounce it? Strategies, I guess, that made us 18,000. So I don't know what strategies are, but they've got to be something good. That's got to make it worth buying the book, I suppose. But I think they did fix that in the new covers, and yes, I can confirm that those were fixed, but they gave us this image with a typo in it. In any case, someone's asking, how do you know when to buy a pocket pivot and when not? I think we covered that. But remember, the volume level on a pocket pivot only needs to be higher than any down volume days over the prior 10 days. And you can find that on our facts section. Somebody asked, what platform software do you use to scan for pocket pivots? We use O'Neill's institutional product, Wanda. I think MarketSmith can work. You can do it on eSignal. You can do it on Telechart 2000. I think you can do it on TradeStation. But usually what I do is I already have a list of stocks that I'm watching, and all I do is I scan those stocks every day and look for pocket pivots occurring in any of them. And then we have our own customized pocket pivot screens. I think if you go out there and search, you can find one available on Telechart 2000. I also know that High Growth Stock Investor, or HGS Investor Software, which we use their charts in this presentation. They actually have a chart template that highlights pocket pivots on the chart for you. So you can check that out. That's at highgrowthstock.com and check out their product. We actually get a lot of support from those guys, Ian Woodward, Ron Brown, George Roberts over there, and they have created screens within their system that are based on our work. So we are recording this, so pocket pivot volume, it can be below average. That is correct. All it has to do is be higher than the highest downside volume over the prior 10 days. And I would add that you can have a higher upside volume day. It's just you have to compare it to downside volume days. And of course, all of this is explained in great detail in both of our books as well as our website. And on the website, there is a free facts section, FAQ section, where you can have most of your questions answered. So does it matter where the price closes on the day of the pocket pivot? It should close up, and some people ask if it's higher than 5% above, do we use the extended rule of 5% beyond a buy point? Dr. K, can you address that? When do you consider a pocket pivot to be extended?
Well, it really comes down to your risk tolerance levels, but I would say you use a similar strategy as you would do with base breakouts. So if you're seeing the proper buy point at say 20, and it of course relative to this chart, if it looks extended, then you don't want to be buying it. Now it's everything's contextual. So if the stock is very low volatility, you probably don't want to be buying it even 3 or 4% higher than the buy point. If it's a IPO and it poses great potential and it's quite volatile, then you will want to give it a little bit more room. So buying it up 5 or 6% may not be extended in the context of the chart.
Yeah, and just like looking at some of these, I'm just going to backtrack through here and look at some of the ones we looked at the very beginning. So just using an example, let's say this one, you see at the end of the day, it's at the 50-day. You would try to buy it as close to the closing price as you could in most cases. But even the next day is actually a viable gap up, so that's another thing we'll be talking about next week. But so you could have come in on either one of these days. But the way I look at it is if it closes within the range, if the range isn't too long and you're within a couple, 3%, that's generally close enough. I think more than 5%, you're probably getting a little bit extended, and you would wait for a pullback. So the pocket pivot should generally occur up through or off of the 10-day or the 50-day. Notice here you have the 10-day, the magenta, and you've gone up through both of them actually. But it could also be in a position where, let's see, where you come up. Let's see if I can find it. Here's one where you're actually coming off of the 10-day, and here you're coming off of the 10-day. So you already had closed above the 10-day the prior day, but you come right up off. So basically off of or up through the 10-day or 50-day moving average. Is it important that the 50-day is moving up? In most cases, it can be moving sideways. So does OCN have good fundamentals? It does, actually. It has great earnings growth. You're trying to buy pocket pivots on the day that they occur. Sometimes, though, you can buy them the day after. I would give an example. Today, we had mentioned to our subscribers yesterday the pocket pivot breakout actually that occurred in Home Loan Service Solutions, HLSS. And if you look at the stock today, it's just pulling back 14 cents. And yesterday had the pocket pivot, so a little pullback like that gives you a chance to buy it today. We do own the stock, just so you know, it's fair disclosure, but you can see that's an example. If you have live charts right now, you can look at HL, Harry, Larry, Sam, Sam, and you can see how you had a pocket pivot yesterday, and it's pulling back a little bit, and so it's buyable today. So as long as they're within range, you try to buy them. Generally, your stops, you can approach your stops depending on where the stock is showing the pocket pivot within its base. So for example, most of the time, if we see one coming up off of the 10-day, Dr. K, what are you going to use as your selling guide? And let's say in this Decker's example, you see this pocket pivot right here. What are you going to use as your selling guide?
Well, initially, you want to be using, if you're using the 7-week rule, that means if it violates the 10-day in 7 weeks or less, then you're going to switch to using the 50-day as your selling guide. Otherwise, you're going to use the 10-day. Now, the other point, though, is it's contextual with what the market's doing. So if you buy there and the market gets weak, then you might not want to wait for the 50-day, or you might want to just sell the stock if it's not behaving right. Or conversely, if the market's strong and your stock is not moving with the market over a period of a few days, then it might be a laggard, or there might be something wrong with it. You might want to switch money out of that stock into something that's showing more promise. So always keep in mind that what you do with your stock should be in context with what the general market is doing.
Let's see, somebody says, so a pocket pivot is any up day in a base consolidation that has higher volume than a down day over the past 10 trading days. That is true, and you also want to see that occurring in a constructive part of the base. So in other words, it's in a part of the base where it's tightened up a little bit, and generally that's going to be on the right side. So you can even see in this example, you're coming down, and it takes a little time for the stock to stabilize, and then it stabilizes, and then it starts to tighten up and stops wiggling around like it is in here, and it gets tight, and it holds in a nice little range. So it's moving sideways and very constructively. That's where you want to come into it. And generally they do occur on the right sides of bases. They don't have to, but they generally do. MCP did not have good fundamentals. That's true. Somebody points that out. Just a good story. Well, it was a very compelling, I would say, theme, and it was a rare earth metals theme. And so, when we were at O'Neill, we would buy biotechs that were losing money, and there were some exceptions to the rules. There were even periods where we shifted from stocks, from growth stocks and, say, tech stocks and the high flyers of the late 90s. And I remember in 2001 I was buying Lockheed, and at the time it didn't have the greatest earnings on the planet either, but it actually was showing a number of pocket pivots along the way up. And so there are always exceptions if you understand what constitutes a valid exception. I think the first key always is a technical action. So you knew that the rare earths theme was in play when you started seeing a lot of these stocks popping up, and you saw what we thought was the leader in the group, Molycorp, blasting up through the lows of its base. So why isn't the next blue tower a pocket pivot? I think you're talking about this, maybe say, you see this is not a pocket pivot because it's gapping up, but that's actually a viable gap up, which something we're going to talk about next week. Coors has had a few pocket pivots as of late. Dr. K, can you answer that question? I don't see any real pocket pivots in the pattern. Do you?
Let's see. Coors, no, there's nothing there. I mean, the last pocket pivot was arguably on December 18th when it came up through the 50-day, but that's a low-quality pocket pivot simply because the stock is still in a basing formation, and that's on the basis that it came straight down to the 200-day on big volume. And it also had, it looks to me like an earnings that may have been disappointing. I can't say for sure, but it certainly didn't act right. And then it goes back and forth, back and fills after it hits the really the 40-week moving average there. So it's not ready. I wouldn't be touching that stock on December 18th, And then it had another 2 days later on December 20th. It had another pocket pivot off the 50-day, but it's still it just doesn't. To my eye, my chart eye, it doesn't look ready yet.
Yeah, and also notice here on this pocket pivot here, this is a V-shaped pocket pivot. So we just talked about how these are failure prone, and the thing breaks down. So You know, this thing is not really set up. Wouldn't you say so, Dr. K?
Yeah, and there's no double bottom going on here either.
Yeah.
So now
So
going forward, it looks to me like it may, if it tightens up here in the pattern and then issues a pocket pivot, that would be actionable.
right. Somebody's mentioning MS has a pocket pivot today. That could be seen as a viable gap up, probably. You probably, let's see, had a pocket pivot. I'm looking in here. I've got a bunch of silly moving averages in here that I should take off. I'll take that one out, clear it up here a bit. Nah, I don't see anything. Maybe this one. Nothing really. This one's kind of a, you know, MS is kind of a fundamentally not the hottest stock on the planet, but it's moving, and you could consider that to be a viable gap up today, but that's not something we're talking about. But that would not be a pocket pivot. But you know, what's in a label? So you're just labeling it. We use pocket pivots and viable gap ups as our buying tools. Someone says they miss. This is a good question. They miss some pocket pivots because the volume does not appear to be high enough until late in the day, and then I feel the stock is extended. If I buy on the following day, the stock is often well off of the 10-day moving average. I want to limit my risk and buy on the day of the pocket pivot. Can I take a chance and anticipate the volume? I think you can, and the way you would do that, let's say that the volume, the downside volume, say 7 days ago, closed at 10% above average, and you're halfway through the day today, 8 days later, and that's, you know, 8 days ago, that's your highest upside volume day, and you're running at a rate today that's, say, 50% above average midday. And I know that MarketSmith and the tools that we use from O'Neill, they will show you that. And you could figure, okay, this thing's running at a rate that's high enough right now, if it sustains, to take out that downside volume bar of, say, 8 days ago, in my made-up example here. And you could just go ahead and take a position initially and then maybe add to it at the end of the day if it confirms on the volume. So that'll help lower your entry costs. People are asking questions here. I'm trying to go down all these... Somebody's asking us to expound on answers in the book, but I don't know what that is, and that's not really the venue here. We may have a special one for questions about the book. There are a couple of typos in the book. That always happens. It happened on the last book. We have a lot of moving pieces in our books, and sometimes what happens is you go in and correct errors, and even then, when they correct them incorrectly, which is frustrating, but it happens, and it's part of the process of writing these very long and large detailed books and doing it as quickly as we do. Most authors take a year, sometimes more, to write a book, and we put them out in 3 months, and our publisher pushes us to do that because they know we can, and we oblige them. But I think the less time you take, there's always the risk of more errors, but I think for the time that it takes us to write a book and the amount of detail in the book to come out with 2 or 3 or even 4 or 5 errors, a handful of errors and typos, is not too bad. But we will be posting an errata list on our website soon, along with this webinar, which we are recording, and we will make it available to all of you by emailing out the link for it later on, or just posting it on our website. Can we do that, Dr. K?
Yes, absolutely.
Okay. Now, we're getting about an hour into this. It's longer than we wanted it to go. We're trying to keep these short. But as always, we can go on forever because we have a huge house of people right now online attending this webinar, and the number of questions is way beyond what we can answer right now. But if you would like to email us, you can do so at, well, what's the best email address for them to hit us with questions, Dr. K?
I'd say support at virtueofselfishinvesting.com.
Okay, and
also
if
they just go to selfishinvesting.com, then it becomes very clear how they get a hold of us if they have questions.
And you can just go to this website. Also, there are FAQs, and we would encourage you, if you have a question, you can type the question into the search field, and it will pull up an answer if there is one available on the FAQ. And if you have any further questions, just feel free to email us. We'll try to get to them as quickly as we can. And also, it helps to read the books, I suppose. That would work. And we attend this newest book more as a hands-on, get down, get dirty, where the rubber meets the road sort of approach to our previous book, to the material in our previous book. forcing the reader to get involved in terms of identifying pocket pivots, identifying bases and boxes, and all sorts of fun stuff, and as well as trading simulations. So we tried to make it more of almost like an activity workbook. I advocated having a coloring section in there too, but it turns out we didn't need it because this book is, as far as I know, I've never seen a book on the markets that's in full color, and this one is in full color. So pretty charts everywhere, and hopefully everybody will pick up a copy wherever they can at their nearest virtual bookstore. Anyways, that's really all we have time for today. We could go on much more, but this may provide the genesis for some more broader webinars later on as we progress through the 3 sessions, or the remaining 2 sessions of our Disciple Bootcamp. Next week, 8:30 a.m. Pacific, 11:30 a.m. Eastern. We'll be back here live with a webinar on Bible gap ups. So I want to thank everyone for showing up today, and happy trading.
Thanks, everyone. Take care now.